Well, financial conditions tightened, but we've got no major alarm bells at this stage. But we are seeing investment managers looking at the right hedges for the evolving economy. We see the US dollar really at the backbone of this evolution between tighter financial conditions as their dollar index trades to the highest level since March, as the exceptionalism story continues to evolve as well. Now, we preview what's happening in the ECB meeting next week. We look at the trades around that and also the US CPI print and also Apple as it trades into Wonderlust next week. We look at trades around the Mexican peso and other factors as well. It's time to get in front of the screens. This is the trade-off. Well, hi traders, my name is Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds by Blake Moreau from Forex Analytics. And we're going to go through all the charts, all the navigating, the various thematics and the playbooks around the key event risks that are coming up onto our radar. So I'm going to bring in the great man into the program, Mr. Blake Moreau. I wanted to, there's so many cool things that are going on. I mean, I say cool is not probably the right word. I think there's something that took me back last night was, we have seen some of the LATAM central banks cutting rates. We've seen that in Chile. They're cutting rates 75 basis points. Some people are looking for 100, but they're aggressively easing now. We expect more, probably the Mexican central bank to come out later this year, probably in December and start easing. Brazil as well. But the Polish last night, I mean, if you want to go hard or go home. The market was expecting 25 basis points of cuts. They went 75. So what we've seen is we have seen a situation where some central banks, when they're raising in that cycle, were raised by 25 basis points more or 25 basis points, more in terms of cutting. But to go 50 basis points, I mean, that's a punchy statement, right? I mean, when I saw that coming through, I was like, whoa. But there's Lottie obviously getting towed up on the back of that one. But I think that was a really, I haven't seen anything that big a magnitude of beat for a long time.
No, and that probably speaks to you a little bit about what other central banks may be thinking moving forward. I think that we got to take that as a kind of a clue, or maybe forward looking, that we might start getting some central banks that come out a little bit more dovish. And we've got a huge month this week.
We do.
Huge month. Next 2 weeks. How about that?
Yeah.
Anyway, that's what I meant to say.
Is it a case of starting to get a bit more bearish on emerging markets? Are you potty to be long as Lottie?
Oh my gosh, I can't believe you just said that.
Sorry.
You were punchy today.
It's nearly Friday, mate. Anyway, but that's an interesting one. I just want to chuck it out there because what we're seeing in emerging markets now, they led us in there. They aggressively hiked before the DM central banks. And, I think we haven't seen a situation where a central bank has gone so far above expectations. I mean, that was a statement of intent there. Anyway, let's go into the factors that are making news. Let's go into topical thunder. Right, I'm going to bring up the dollar because the dollar has been on a one-way tear. I put this down to the smile theory. We put out an article about it yesterday, but you've really got both sides of the smile theory working concurrently for the US dollar. On the right-hand side, you've seen quite poor data in Europe. I mean, the Chinese data, sort of amplified by the Taishan services data earlier this week. I'm saying this before the trade data comes out in China today, but the UK data is looking precarious on the services side. 1 month doesn't make a trend, obviously, but we are watching that. European data we talked about, but the US still looks that kind of better exceptional story, and we saw that from the ISM services numbers overnight or in your day. On the left-hand side, we haven't really seen too much in the way of a risk-off malaise. Credit spreads are still very, very tight. The VIX is just above 14%. We're not seeing major buying of implied vol at the moment. And the S&P and NASDAQ, they've had a little bit of a pullback, very, very modest. It's still not far away from all-time highs. But that said, I think, the exceptionalism story for me is still working, and you've got bond yields, in twos breaking above 5%, which is supporting. Are we going to get a rate hike in November or not? And that's how we've been looking at the US dollar. I personally still like the dollar. I think pullbacks will be pretty shallow. It's still looking like that best house, Blake, in that neighbourhood. So, I think sterling's cable's traded to the downside. Aussie's obviously just a proxy of what's happening in China at the moment. Euro dollar's broken through the March uptrend. You know, you can name it. Dollar Mex looks really good at the moment. You know, we've seen the Mexican central bank unwinding some of its forward hedges to an extent, which I think is a statement to the market. What I haven't given you much time, I'm afraid. Sorry, I've just gone on a bit of a rant, so I'm a bit spicy today. But how are you seeing the dollar broadly at the moment?
Well, that's fine. No, you're already weeding into some of my my other topics for today anyway.
Sorry,
but that's all right. That's all right, Chris. I'm going to just give you the reins and you just take off. No, I'm playing the dollar on the long side. I think it's tough to play the dollar on the short side. Yeah. Actually, I believe last week we had a setup, or it might have been my play of the day, of the dollar Swiss on the short side.
Looking good.
And I'm like, no, I was short. It was just it turned and it broke out, and I said I'm gonna stop and reverse.
Yeah.
I didn't. I was too focused on other things that I was long the dollar against, which was fine. It all worked out. But I think shorting the dollar is really tough. Even the dollar yen, here we are, on our way to 150. Yes, there's some comments that have been coming out from over the last. We have the Ministry of Finance, but what are they going to really do? I mean, intervention could cause a little blip, and you might see some dollar weakness. But remember, it's a yen story, so you would see euro yen go down. Therefore, the dollar would rally against the euro. So I think the dollar still looks really good. I think the exceptionalism is going to turn out to be the cleanest dirty shirt in the next couple of months. But I believe that the dollar still looks great. And you sprinkle on a little bit of risk aversion, Chris. I mean,
that would get it going.
Stocks are.
Yeah, if we saw VIX pushing up and rates vol pushing higher, the move index, you can stick on that one. Then the dollar will get that extra wind coming through. I mean, but yeah, look, I mean, I forget the Canadian GDP numbers. No one was expecting a contraction there, and that was, just sort of added to that pile where the US is just looking a little bit better. Have a look at that rate story for 2024, the SOFR futures, which you can get on TradingView. I'm happy to share that one out to you. But you can see what's priced for between December 23 and December 24. We just made new highs there. So we've got 104 basis points of cuts being priced in for next year. Not a sign of a recession, more a sign that the Fed are going to start to normalize and bring it back to a more neutral rate. But that's the lowest levels of implied cuts that we've seen in this cycle. For a large period of time. And again, I think that's just boosting the US dollar. So as a world where we're sort of sitting going, are the ECB done? Are the Bank of England done? Obviously, don't talk about Bank of Japan. The RBA are done. Bank of Canada done. Are we going to see another rate hike from the Fed in November? Yeah, that policy divergence, again, just shows that the US dollar is a little bit better in that situation there.
It does. And that's going to take us to our next topic, Chris, is let's talk a little bit about the ECB. And I guess the question that I have is, do they and can they raise rates? If you look at the last ECB meeting and you look at Christine Lagarde, she obviously has turned a corner from being very hawkish to more dovish, slightly neutral to more dovish than anything. There's the market's kind of will they or won't they? And my propensity to think that they're not going to raise rates as deflationary type of pressures start to hit them. I think that their data is weakening. There's tools that they can employ, like they could increase like reserves, bank reserves. They could actually divert the PEP repayments. I think there's things that they could actually do to not raise rates and stay steady from here on out. And you were just saying it, look, Bank of Canada, they just held. ECB, they might hold too. I mean, where do you stand with the European Central Bank and what they're going to do next week?
It's difficult, isn't it? Really difficult, because we've seen the likes of Schnabel, one of the hawkish members, talking the idea that a much more balanced view. And if you look at the data of late, given where core CPI has been pulled back to, and obviously the PMI series, both on the manufacturing and services, and the IFO survey, there's definitely reasons for them to sit on their hands. And so my gut instinct suggests that they will pause at this meeting. That said, we saw ECB member Knott last night, and also Casimir, suggesting that the market had underpriced the September rate hike. So it's given a bit of an element of doubt. So it's a live meeting, and it's probably going to be one of the most exciting meetings for the neutrals, those that don't have positions, we've seen in a long time, because it could go either way. But I think my instinct tells me that it's not going to happen. What's most important for us, Blake, of course, is how we're managing euro exposures over that meeting if we choose to have them. And I think we could see implied vol pick up around that meeting. And that obviously means, I'd be looking to reduce my position size because it could go either way. What's also important is market pricing. We've got 8 basis points of tights being priced in for that meeting. So it's a 36% chance in the market size that we get a hike. Therefore, if we do get a hike, then obviously you're going to get a more pronounced move in the euro to the upside than what you would do to the downside if they left rates on hold. So that's obviously another factor. And then obviously you've got positioning and liquidity and other factors as well. So I think they leave rates on hold. What do you think?
I do think they leave them on hold, Chris, and that's the way I'm going to try to position that way. As I think that the dollar is going to be able to shine, the dollar smile theory, if you will, the exceptionalism. I think between the market looking ahead with CPI after we get CPI next week, we're going to have an opportunity to be long dollars and short euros, and I think the euro is going to trade south of 107 towards 106, and maybe even wear a 105 handle.
It'd be interesting to see. I mean, at the moment, clients are loading up on euro longs at the moment. They're fading they're fading dollar strength at the moment. Obviously, that's just a natural thing you see from retail traders when you see this extended move, and they just love to counter those kind of situations. I will say, though, if you look at investment bank flow reports, that the asset managers and leverage funds are pretty long of US dollars, not to sort of nosebleed type territory, but that's something that we look at when you go into these events. Market positioning and rate expectations really do matter about how we manage those risks. So it's interesting. I think they keep rates on hold, but would I want to hold euro exposures over that meeting? I would certainly want to come back a little bit.
For me, it's always going to be about how much runway you have, right? If you're profitable enough where you can take a little bit of a wiggle, and you're not going to give back too much. That's the way I'm going to play it. But anyway, I know we need to move on.
Let's switch lanes, because we're going to the FOMC meeting, which comes out on the 20th. The market's not expecting the Fed to hike. There's very little chance that the Fed are going to hike at that meeting. But November is very much up for debate, which is why I've used that title, Gun to November, which I think is one of your favourite bands, the Fugees, wasn't it? It was one of the Wyclef John who sung that. But that's the thing. So we're 50-50. It could go either way for November. So the CPI print next week is going to be a piece of data that the market will want to understand to increase. Do we have our base case that they raise in November, or do they subtract that coming through? Now, I look at that CPI print in 2 ways. You've got headline inflation and you've got the core inflation read. Core inflation is expected to pull back a little bit, but the headline number, because of base effects, is expected to kick up to about 3.5%. The Cleveland Fed themselves have got a nowcast model on that, and they're seeing that coming out at 3.8%. So if that's right, there is definitely some upside risk to headline. But that's a really big one there, because you get a situation where the ECB leave rates on hold, that 8 basis points comes out the euro. We get an above consensus core CPI print, headline print. That euro dollar could be trading markedly lower. So how are you trading? How are you thinking about that CPI print? Where the risks, and how do you see that playing into the FOMC meetings for September and November?
Well, because I think that September is off the table. Yep. I think a hot print. You think about the ISM data that came out today. That was way hotter than expected.
Scorching.
It's scorching hot. And
especially
remember, good news right now.
The prices paid element of that was quite concerning, I suppose.
It is, and I know the S&P PMIs came in a little weak, but look, good data is not good for equities. Good data is going to be good for the dollar. And right now, strong data, good for the dollar. Core CPI, it's going to tilt the percentages that the Fed actually moves in September in 2 weeks. So we'll have a week out before we get to the Fed. Regardless, the dollar could make a move between now and the FOMC. So, Chris, I'm just continuing to play the dollar on the long side on dips, and I will point out actually in some charts to show you just how shallow the dips are, because it's not giving people the opportunity to reload. It's not giving people the opportunity to exit. It's a one-way freight train right now, and you got to respect that type of price action. Yeah. Are you playing the dollar on the long side?
I would only play it from the long side at the moment. No, I mean, the positioning is getting rich, and that's something that we need to think about. But if the dollar's going to make a move lower, it's going to be because of people just taking profits and taking positioning. The investment case is not going to change overnight, and that is that, as I say, we're debating whether or not we get a rate hike in November. The opposite is true in so many G10 countries. We're actually debating whether they're going to hold from a position where we'd priced in a really good chance of a hike, and now we're doing the opposite. So the two things are separated. And so I think that investment case isn't going to change. I mean, obviously, if we were to see a really weak core CPI print, then I think, the dollar's going to get whacked pretty hard on the back of that. And that's a risk, again, something that we need to consider, those dollar positions going into the CPI print. You know, if we look at the last 6 CPI prints that we've seen in the US, in the 30 minutes after the CPI data, the US dollar's fallen every single time. So, the form guide would suggest that that's the case. But yeah, look, these are risks. It's how we trade. You know, our job is to manage the risk around these events, understand the skew and the distribution around them, and work out, do we want to hold those exposures? Do we want to reduce them? So the CPI prints there as well. We could easily say, to answer your question, I would only be long the US dollar right now or neutral, but shorting it for me is a pretty tough trade. It's a fairly low conviction trade. At this point, I would want a bit of momentum to go in. I like trading on momentum. Anyway, let's go into. Go on, sorry.
No, I was going to say, let's go ahead and go into the next topic. And we're going to have by next week's trade off, we're going to have a good idea, because we'll have already seen what happens with inflation. So, all right. So let's go into crude oil, and it's a topic of conversation because crude is breaking out, Chris. It is. It is breaking out. I mean, you want to talk about one of the reasons why the dollar Canadian doesn't trade at a 140 handle right now? It's because of this crude oil move. And, I think that people really have to understand a couple of things about crude. The move in crude has to do with supply. You've got Saudi Arabia and Russia, they're going to be cutting output for the next, 3 months?
Yeah, right. I mean, December, yeah. That's what the Saudis have said. So, I think there are 9 million barrels a day of output, which is cut back, and that's been pushed out to December. And the Russians have done not quite to the same extent, but they've agreed to push them out as well. So yeah, you're right on the supply.
Yeah, it's a supply move, and everybody's. I think they've got that Pavlovian response, and they have which makes sense. By the way, as I say this, you'll understand. A lot of times when you're looking at crude oil and you think, oh boy, look, crude's rallying. It's rallying with risk. Stocks are going higher. Dollars moving lower. Crude's moving higher. Great. Everything. I can see rainbows and unicorns. Everything's great. But right now you're seeing a breakout in crude, which is going to make the job really tough for central bankers as this energy costs start to go through the roof. They're already elevated already. It's going to make them it's going to make it very difficult for them to follow in the footsteps of the Polish, of the zloty, if you will. So with that being said, you've got a situation where we are seeing crude breakout. We got to respect the fact that it's breaking out and understand that it's not good for the economy, and it's going to keep central bankers more on the higher for longer or steady for longer path than I can start cutting rates soon, going earlier into 2024. What do you make of this move in crude right now?
Well, I think demand's there as well. I mean, we see, the forecast from the International Energy Agency is showing really, really strong demand. But what's pushed this up here is around the Saudis and Russia, and other factors that are playing through in parts of Africa as well. But I wouldn't want to fade this move. I'd be wanting to buy pullbacks or neutral, but I think we're just exploring. Now, going to the options market, Blake, Brent, people are buying upside calls now into Brent options, well above 100 now. So the options market is certainly sniffing that one out. The curve, if you look at the futures curve, is significantly backwardated now, and that incentivizes people to be long for that roll down. When you get to expiry, you roll down to a cheaper contract, and you get that positive carry, which of course to anyone who's in the futures market is really, really positive indeed. You always want to see that situation playing through. I think it goes higher. When you're talking about geographical issues, think about those countries which are big importers of energy relative to the exporters. So Japan, a massive energy importer. You know, if you're looking at why part of the reason why we're seeing weakness playing through in the Japanese yen, I think it's because when you're seeing energy, ramping up, the countries that import are going to struggle. You're going to shy away from them. So that's another factor we need to think about as well. Yeah.
Imagine buying crude in yen terms.
There you go. Well, you could buy gold. Buy gold in yen terms has done very well. So there you go.
There you go.
There you go. Record highs coming through. Anyway, let's go to the setups that have caught our mind. I'm going to go to cable to start off with, and as always, if anyone's got any charts you want us to look at, do pass them over to Blake, myself, either through social media, go reach out directly to us, or write into the comment section and let us know what's going on. But there's a couple that we've been focused on, and that's cable here, Blake. You've got the head and shoulders there. You've got the real stage down that hit the 50-day moving average. We closed down. We've broken the neckline. We made a lower low here. 200-day moving average coming through. Fundamentally, of course, you saw Governor Bailey talking about this table mountain approach, this higher for longer coming through. Sorry, that was Hugh Pill, sorry. But Governor Bailey's been speaking overnight as well, and he's come out with some pretty dovish comments that he believes inflation is going to crater going forward, and that we could be seeing the last of the interest rate cycle. So again, sterling, which was so strong, is now one of the weaker currencies, and I like to trade this from the short side. Again, selling any kind of rallies in this pair. I think that 200-day moving average just above 124 kicks into play sooner rather than later. Obviously, that CPI next week is going to be key. How are you playing cable at the moment?
I've been playing it to the short side, and the thing is I want to be short until we get to the 200-day moving average, which now happens to be very close. But this is one of those pairs that I have been playing the dollar through. I figured if the euro is going to break down, the sterling's going to be playing well on the short side. It fell a little bit further today than I thought for the reasons that you had mentioned earlier. But if you just take a step back and look at that chart, just kind of blur your eyesight, that is a head and shoulder pattern that's playing out. Yeah. 124.50 is going to be a really key pivot. That was a big breakout point from back in early 2022, I believe. You have to kind of keep looking left in your charts. 124.50 is going to be big. We're getting real close. The 200-day moving average really close. I like it on the short side. It's a clear breakdown right now.
Yeah, and the other thing as well, just before we flip over to EURMXN trade, we've still got 50 basis points of tights being priced in. Now that includes the next central bank meeting later this month, where the market's pricing in 22 basis points. But I think they're one and done. I think they're done. I think those comments from Hugh Pill, the chief economist on the Bank of England, talking about this table mountain, suggests there are real risks they sit on their hands at the next meeting. I don't think so. I think they get one more rate hike at the next meeting, and that's them done. But the market's still pricing in 2 hikes. So again, that just keeps me a little bit bearish on the pound. Whilst we're going to get higher for longer, that's a thematic that's playing across most of the G10 central banks, where we're going to see them held at elevated rates. I think 50 basis points of tights being priced into UK rates to terminal pricing is still a bit punchy, and I think maybe one of those comes out. Again, it keeps me believing that we've got some downside risks in cable there.
Yeah, I believe so too. All right, well, the next, my first setup is going to be the Euro-Mexican peso, and this is, are you still feeling lucky, Chris? Do you?
I feel lucky, mate.
You feeling lucky? You feeling lucky? All right, are you feeling lucky with those carry trades? Last week, Mexico, as you mentioned earlier, they decided to slash its hedging program, that they used to stabilize the Mexican peso post-COVID lockdowns. Because if you don't remember, and it's not on this chart because you'd have to keep looking left, we had the COVID lockdown. The dollar rallied against the Mexican peso, I think 40%.
Yeah, so it's a bit less than that.
It was. Go ahead.
Well, I was going to say most of the selling of dollar mex actually took place in 2017, but the hedging that they did in 2020 was, a fantastic trade by them. To be honest, they've done pretty well out there.
I mean, you got to hand it to banks ago. I've seen central banks over the years do these types of things, like the RBNZ played the Kiwi beautifully following the GFC. back in 2008 to 2010. They were buying, getting long so much Kiwi. It was crazy. Anyway, Mexico is unwinding that program. It's kind of like that, special circumstances. It's kind of like having rates lower for longer, for emergencies, and same with this hedging. But since they've done it, the EURMX and the $MEX have lost about 4 to 6%, depending on what currency you're looking at. But the EURMX had rallied quite sharply. Now, as a result, we are back up against resistance. And if you're a carry trader and you're like, okay, I think stocks are done going down, I want to play this back to the short side, this is the place to do it. But what are your thoughts on the EURMX? I think we're at a very big inflection point while we're below 1910. Yeah. Go ahead, Chris.
Well,
sorry,
I think,
I took up all the time.
I'm interested because like you bring up a chart that's pushing resistance and is yet to complete. Yeah, there's no trade there for me right now. One for the scalpers maybe, but $MEX has actually broken out, and it's broken out with real force there. So it's not just about the unwind of the non-deliverable forwards, or part unwind, should we say? But there's obviously the dollar play that's gone in through to that as well. I don't think this is a proper unwind of carry. For that, to me, you'd need higher implied volatilities to really get that carry trade unwound pumping. But it's interesting that you've got EURMX here, because that's yet to complete. So it is a setup, as we like to talk about there. Yeah. But $MEX has actually broken out. It's in beast mode at the moment. So would you be trading $MEX over euro? Well, I know you're bullish on dollars, but wouldn't you trade $MEX over EURMX there?
Well, I'm actually long $MEX below 17, so I'm already long, and I was long EURMX and just took it off literally this morning as it went up against resistance right here. But I think it's at a key inflection point, and if you believe that stocks are going to stabilize at near current levels around the 4450 level in the S&P, and you think that maybe the ECB will not hike and they're just going to keep rates on hold,
yeah, it's a good one.
Perhaps the EURMX is a good short up here, and that's why I think it's a great setup. And on a breakout above 1910 is bullish.
1910. Okay. Well, also you've got Mexican CPI numbers in the session ahead. That could be quite influential. The market's expecting the bank's code to start easing in December. This CPI print in the session ahead could see them toying with the idea that comes sooner. So that's another catalyst for your trade. So yeah, really good setup. I really like that. It could go either way. Well, a lot of fundamental drivers there. So put that one on your radars, ladies and gentlemen. I want to go into Apple. Canvass your views there. I mean, we saw that, I think, having its worst day for some time in the session we've just gone past. A lot of that down to geopolitical headlines, but headlines that Chinese government officials are shying away, or been told to shy away from Apple products. I think this is probably a thematic that you're going to see far more about as we go into the election next year. You're going to see a lot more of those sort of headlines coming through. And certainly from the US side, not so much from the China side. But look, when we moved up, we almost filled the gap that you can see there, Blake. And gaps are there to be filled, but it's how price reacts into the gap. And now obviously that's been met with some pretty stringent news. Now, bear in mind that Apple made 19% of its revenue last year in China. So obviously it's a big deal. The semantics towards China is a big deal. If government workers are getting told that they have to shy away from Apple products, that could extend into the wider region. So semantics at heart there. Whether this lasts is yet to be seen. But Apple, obviously one of the most, if not the most important stock for the NASDAQ and for the S&P. So as goes Apple, if we lose the leadership there, I mean, you'll be buying volatility in the NASDAQ. So how are you seeing that one?
Well, Chris, how long ago was it that you were at you were in the UK partying it down for your mate's wedding?
A couple of months ago.
What, a month ago?
Yeah, a couple of months ago.
Yeah. So it was like a month and a half ago. We had this as an ascending wedge, looking for a breakdown, and it broke down magnificently. Loved it. Now that gap fill, I'll tell you what, technical analysis and gap filling, and it's very similar to horseshoes and hand grenades. Close enough works, and in this situation, close enough works. I think that was a nice gap fill.
Can I use that line? I'm gonna plagiarize that one. Sorry, mate.
Absolutely, you can use it all day long. Horseshoes and hand grenades, and technical analysis all works in hand. But because it failed right there at the gap fill, I think it's a clear short, because your risk is very well defined that you just sell rallies as long as it doesn't surpass that level. So that's it.
Well, I think if we got,
I like it.
If the buyers do step back in and see this as a, just a bit of a story that's not really going to evolve, then yeah, I think this is really key, because if it does break back that level, if it breaks above the gap, we're going to get new highs in Apple, and that will mean we'll probably get very likely get new highs in the Nasdaq as well. So this is one I think everyone, especially index traders, US index traders, need to have on their radar, because if Nvidia starts to crack for other reasons, we were to lose the Magnificent Seven in that leadership, then Apple's obviously a big component of that. Then, I think the Nasdaq's got some downside risk. So this is one that you've got to put central on your radar right now.
Yeah, absolutely, Chris. Absolutely. All right, well, let's move to my last setup, which is going to be the Russell 2000. And I want to remind everybody, if you have a setup that you want us to look at, a currency pair, an index, whatever that you want us to look at, make sure you jump in the comment section down below and let Chris and myself know. Now, you'll notice with the Russell 2000, it's been the laggard for the indexes. You can see that nice triple top developing up there. Well, I also spy a head and shoulder pattern. And if you have kids, you may have sang the song head and shoulders, knees and toes, knees and toes. That's where knees and toes comes in. Yeah. If you're wondering down below.
And ladies and gentlemen, if you are going to put a chart in, put your preferred comment and line. See if you can out comment Blake there.
Yes, if you could beat knees and toes, I'd love to hear it. Yeah. Anyway, good, because I need some variety. So you can see a nice clear head and shoulder pattern setting up. But notice the neckline. This is what we call a complex head and shoulder pattern, meaning the shoulders are slightly off. They're not exactly horizontal. They're more diagonal. So that means the neckline is going to be somewhat diagonal. That means the neckline's right around the 200 DMA, which happens to be the red line that you see there. And if you put a quick fib from high to low or low to high, you're at a 50% retracement there as well. So, which is not on your chart. The point is, if we break below the 200-day moving average, more importantly, if we get below 1830 on the Russell 2000 index, this is on your Pepperstone CFD, chances are we're going to reach for those range lows that you see that we haven't seen since like way back in like, what is that, June of 2022. Jesus. So we should revisit those levels if we break that 200-day moving average. But for those of you that are bulls, if you are bullish, you could probably play it off that 200-day moving average with limited risk. What are your thoughts here, Chris?
Well, I like when I like head and shoulder, see those head and shoulders patterns. I always like the right hand shoulder to be higher than the left hand one. I think the market's tried to make a stage, failed. We're not there yet, and of course you wait for them. Like any of these patterns, you wait for the market to show its hand and increase the conviction. But yeah, I think we're looking at the checklist of risks, as we always do. We're looking at things like commercial real estate, student loans, and all these other factors that are playing into the market. I wouldn't act on them at the moment, but if we're going to see any of these kind of macro factors, economic factors play in, higher for longer, that starts to make things break. And I know there's a lot of people out there who are looking at those things that could break. Then the Russell's going to get absolutely walloped on the back of that. So, I don't know if that's going to happen. In some ways, I hope it doesn't. I mean, I like vol like the next person, but there is what we do is we look at the signs that could create the volatility. We check them off and we say we've got real clear evidence. The market's starting to look at this now. And where are we going to see those risks perpetrate with commercial real estate and all those factors? It's going to be in the Russell. It's going to be in the small cap banks, and I think that will. That it may be, people say, Blake, don't be a doomsday. You're not. You're just looking at the technical target. But yeah, I think there's a lot of risks out there that could eventuate, or they may not. And the Russell's the place that's going to get walloped if they do actually manifest next year. So it'll be an interesting one. Anyway, let's go to play.
Yeah, and it's not, I was just going to say, it's not like we're going into uncharted territory either. This is a well-worn range too. I mean, visiting range lows that we saw summer of last year makes sense. It's not, but anyway, but we should move along.
Yeah, right. Okay, cool. All right, let's go to play of the day, because it's actually a nice segue for an idea that I'm looking at the moment. Right, my first trade, I want to go long the Polish zloty. Jokes, pants, as the kids say. I want to have a look at the KR ETF. Now, this is an interesting one because it plays really nicely into that Russell setup. If you look at the Russell 2000, obviously it's a small cap index, but a large element of that is financials and small to mid cap financials. And the regional ETF, the KRE ETF, Got a lot of attention in March. Obviously, that's when we saw the banking crisis playing through, which, of course, the Fed staved off through to its liquidity and the BTFD program. Those liquidity that we're seeing taken up by the smaller and regional banks continues to be very, very high indeed. But look, we started to see some rather precarious price action playing into the banks, which again could feed into Blake's US 2000 R2K trade. So it's a tough one at the moment because we're not really seeing huge momentum. This is early stage momentum building up, but we've seen that bear flag kicking in. I like this to the short side. You can see that stochastic momentum playing through. That's had the bearish sort of function. But shorting this now is a tough one. It needs to build a little bit more before the bid dries up and the sellers can get real some sway there. But it's definitely something we have to have on the radar, because if banks really give up, I know we talk about Magnificent Seven, but if the banks start to show some clearer vulnerabilities, the broader equity market could have higher volatility. It could feed into a stronger US dollar, higher rates, commercial real estate. There's all concerns. I think the KRE is one that needs to be put back on the radar now, and the bears are starting to win over. I like this short. I'd be doing it short, small size. I'll be looking to cut it, but this could manifest into and roll into something a little bit more protracted here.
God, you talked about doomsdayer. I'm gonna go. I'm gonna go. Where's my gun? I'm just kidding.
I'm not a doomsdayer at all. For me, Blake, I'm not bullish. I'm not bearish. I just trade what the market's telling me to see, and right now this setup suggests that it could build. So I'm not a perennial bull or perennial bear. I just trade what the market's telling me. So
you're agnostic, Chris.
I'm an oyster, but
that's what I wanted to say.
Well, if you want to come to visit me, we can get down to the bottom of the garden. We've got a bunker, we've got handguns and canned food down there waiting for us.
That sounds like you live like one of my neighbors. All right, that's going to take us to my play of the day, which is the euro. As I've been telling you guys and gals, I'm playing to the short side, but I want to point out a few things about this chart. You'll notice that upper blue arrow, the little bit bigger arrow, that bounce that we saw 2 weeks ago, that showed you that the bounce couldn't even make it to the 38% retracement, which came in at 109.66. Also, you'll notice that the 50 DMA, we couldn't get back above that. So basically, while we remain below the 50 DMA, you got to continue to focus on the short side. But what's more important is understanding price action. When you get a move, like just say an elongated move, which we did from the 112, almost 113 level all the way down to 108. When you get a long move like that and then you bounce and you barely get to a 38% retracement, that just suggests that there's probably more to go in that same general direction. And that's what's happening right now. We are well below the 200-day moving average. We're below channel support. My next target's going to be, 105.25. Well, you could say, well, there's some levels, between here and there. But it looks like to me, especially if everything that we've talked about, Chris, continues to fall into play, whether you have an ECB that becomes stagnant and they just need to stay higher for longer. You have hot inflation data, CPI over the next week or two, and then you get expectations moving higher for the Fed to actually raise rates. The euro dollar could be wearing a 105 handle. That means 105 XX, in the next couple of weeks. And I think while we're below the 200-day moving average, we continue to focus on the short side. Woo, that was a lot that I had to say. Okay.
Well, it's one of those weeks, isn't it? That we've got a lot to say. We're hopefully I think we always do. And my producer just knows we ramble on a bit too much. But there's a lot to say in these markets. There's, we've got pretty subdued volatility on a cross-asset basis, but there's quite a lot of opportunities, and you're seeing that creep in. So I think you got to keep our eye on that wrecking ball that is the US dollar. If that dollar goes down, so it goes up like Blake's anticipating. Asia's probably going to be the place that underperforms. Keep that dollar CNH on your radar. And for you, all you lovely people out there, thank you for watching. If you've made it this far, give us a like, leave us a comment about anything you've heard tonight, even a setup. Try and beat Blake's title for your idea. And we'll see you back next week for more of the trade-off.